I think that the volatility that we're going to expect over the next 2 years is greater than the volatility that we've come to expect over the last 40. Investors need to be prepared for that financially, which is to say they need to maintain higher cash balances than they otherwise would. Those cash balances are important for two reasons. They give you the tool to take advantage of volatility as opposed to being taken advantage of by it, but they also give you the courage. Having the cash often gives you the ability to use it. And we will have situations, I think, over the next 2 years where there are some fairly short-term but fairly severe market panics. It's important that you also have the psychological stability to weather the panic, that you use it as an opportunity to take advantage of other people's mistakes rather than making your own. A second thing that people probably need to pay attention to is that market leadership and rotation is going to change a lot. And I think particularly for people with a trading orientation, I don't have a trading orientation, but for people with a trading orientation, you're going to have to change from what's hot to what's not quicker than you used to have to do it. Too many people, in my estimation, over the last 40 years, have required the price action of an asset class to justify the narrative around the asset class. I remember back when uranium became hot. When the uranium price had to go up at 20 bucks a pound, nobody but it wanted to own it. Mm-hmm. When the uranium price went up to 80 bucks, it didn't have to go up anymore. The price action had justified the narrative, so everybody stormed into it on top. And I think that most people need to change their orientation, not look at what's hot, but rather what's not, what will become hot. So liquidity and a propensity not to chase fad, but rather to chase logic, I think is going to have to happen. In my own sector, we're in a really good gold trade right now. And somebody needs to decide what kind of investor they are. If they're traders and they became involved in gold 2 years ago and gold is up, 35%, maybe you take some money off the top. Maybe you take some money on it. If you bought it because it wasn't in vogue, it's coming in vogue. And if your reason to own gold was because you thought that gold would go through 3,000, now that gold's gone through 3,000, maybe you want to sell some. For me personally, I think gold has much farther to go. I'm an investor. But if gold pulled back 15%, it wouldn't change my thesis whatsoever. So for me, I'm going to own some gold. Continue to own gold. If you continue to own gold, I think you have to own the gold stocks, because the gold stocks relative to the gold price are very, very, very cheap. If the gold price holds up, operator margins will increase very rapidly, which is to say the money that they sell their gold will greatly outpace what it costs them to produce. And if that takes place, the equity markets will certainly take note of increasing cash flow and earnings. Investors in other sectors, in the resource sector, need to pay attention to changing supply and demand equations. As an example, oil in the 50s won't last. The truth is that the total cost to produce oil on a global basis, not just the lifting cost, but rather the social rents and the cost of capital, are over 60 bucks a barrel. When you see oil in the 50s and you see the oil stocks sell off, if you're patient, buying oil at that period of time and then revisiting the trade when the oil quote is 75 or 80 is a wonderful trading strategy. It's a truly wonderful trading strategy. Of course, it takes courage. And I guess if I had any single piece of advice to offer people, courage is what's going to be required over the next 5 years. For me, some of that liquidity is in gold because I'm not afraid to sell the gold to use it when something gets cheaper. Other people who don't want to sell their gold probably need to consider it as an investment as opposed to liquidity. I think the second determinant in terms of portfolio allocation, how speculative one can be, really is simply a function of how hard you want to work. If you aren't willing to work, if you aren't willing to spend at least 1 hour per month on each of your holdings, then you can't afford to be very speculative. If you are willing to work hard enough to give yourself a definable competitive advantage over other investors and speculators in the market, if you are willing to work hard enough that you can have some sense of what something is worth as opposed to what it's selling for, those are very different numbers, then you can afford to be more speculative if you want to. I would encourage both investors and speculators to think in much longer terms than they do. One of the most common mistakes is, while people are often very right about their investing themes, the themes that they're investing in might take 3, 4, or 5 years to play out. And those same investors seem to have trauma holding stock over a long weekend. If there's a big mismatch between your strategy and your tactics, likely you're going to lose money. And when people make an investment, they have to ask themselves why they're making an investment. As an example, maybe somebody believes in resources, that the political challenges around supply chains means that Chinese dominated supplies like antimony, rare earths, things like that, will become more valuable in the West. It will take 3, 4, or 5 years for that to play out. If you're buying a rare earths company or an antimony company or a lithium company based on a 5-year time frame, and you allow yourself to get shaken out of the stock in July, you understand there's a mismatch between the time required for your investment thesis to play out and the time that you've allowed it to play out. It's odd that people buy financial assets differently than they buy physical assets. I think if people bought financial assets the way they buy physical assets, which is to say they bought them on sale, that they'd have better outcomes. People would say to me, well, Rick, when's the gold price going to move? And I would say to them, well, I think it's going to move in the year 2000. In the year 2000, it was $250 an ounce. Now it's $3,000 an ounce. It's up 12-fold. What do you want? Gold has done its job. A couple weeks ago, I said to the audience, here's why I own gold. I own gold because the world's reserve currency, the US dollar, has some challenges, not relative to other currencies perhaps, but absolute. Those challenges include off-balance sheet liabilities, according to the Congressional Budget Office, which exceed $100 trillion, and on-balance sheet liabilities that exceed $36 trillion, and a complete unwillingness with voters and hence politicians to trim spending. We had this situation once before in my life in the 1970s. And during the 1970s, the US dollar lost 75% of its purchasing power, according to the Office of Management Budget. And not coincidentally, the gold price went up 30-fold. Now, while I don't think the gold price goes up 30-fold from here, I do believe personally over the next 10 years that the US dollar in absolute terms loses 75% of its purchasing power. Traditionally, what's happened is, particularly during periods of artificially low interest rates, when the dollar loses purchasing power, that gold goes up. So a questioner asked me, Rick, what would make you sell your gold? Here's what I would sell it. When we balanced our budget, when we had a fiscal scheme that was popular among our elected representatives that dealt with the net present value of $100 trillion in unfunded liabilities. And when the interest rate on the US 10-year Treasury exceeded in real terms the depreciation in the US dollar. If, Danny, your listeners believe that the CPI is the real rate of depreciation of the US dollar, they can feel sanguine about it. When I look at the basket of goods and services I buy, it would appear to me that rather than the 2.6% stated rate in the CPI, that the purchasing power of the goods and services I buy, gasoline, groceries, health insurance, stuff like that, is increasing by about 7.5% a year. 50 years of following these markets now, and I can't tell you why this is. I'll just tell you that the anatomy of a precious metals bull market is like this. Gold, the metal, moves first. Then the gold stocks move. After the momentum has been established by the fear buyer in gold and the gold stocks, when the generalist money is attracted to the narrative and they come down into the sector, perhaps because of silver's lower unit price, or perhaps because of its reputation for volatility, or perhaps for both, silver begins to outperform gold. And by the way, when that happens, you won't need Rick Rule to tell you it's happening. It is very, very, very dramatic. Now, I believe that silver is a speculative as opposed to an investment asset class. But for part of my life, part of my financial life, I'm a speculator. And the returns that I have seen in high quality silver stocks are so dramatic that I personally can afford the wait. I have no psychological trauma waiting because the returns I've enjoyed have been so great. Let's look back to the decade of the 1970s. One stock, Coeur d'Alene Mines, ran from a low of 10 cents in 1970 to a high of $61 in 1980, a tenfold return over the decade. Fast forward to the great little silver market we had in the early part of the 90s. Two that I did participate in, Pan American, which went from 50 cents with, by the way, a full warrant, to a high of, I believe it was $45 in 7 years. And Pan American Silver, not Pan American, pardon me, Silver Standard, which went from 72 cents to also a high of $45 over 6 or 7 years. The point of this is that the most dramatic performance, albeit speculative performance, not investment performance, but speculative performance that I see in precious metals markets is that sort of limited ghetto of high quality silver stocks. You point out that with regards to the metal, gold has at least reached nominal all-time highs, which is to say, silver at $33, $34 is lower than its nominal $50 high. It's much lower than its real high. If you inflation adjust today's $33 relative to the old $50, you'd probably need to take out 80 or 85 to see all-time highs. And if I am right, that we are in a genuine precious metals bull market as a consequence of the deteriorating purchasing power of the US dollar, you will see generalist investors coming down into the space. You're starting to see them now. At some point in time, if past is prologue, I've seen it happen 3 times before in my life, silver will begin to outpace dramatically gold. Investors or speculators who want to see that may have to wait a year, or they may have to wait 2 years. From my own background, the rent you get paid when it occurs accommodates almost any weight that you want to hang on it.